21st of March, 2023, Tuesday. What happened back in 1990, year 2000, 2008, and 2023 potentially? Apparently, things are lining up, and I think that something is going to go wrong. And I want you guys to watch this video all the way to the end because it's a must-watch video. Loads of information, a lot of economic stuff. If you like all this stuff, interesting pattern, today is something you don't want to miss. All right, let's go. Now, first of all, thank you guys for all the comments that you left for me to go and get yourself a chance to have a lunch with me on the 29th of March next Wednesday. All right, this place is at Paragon. All right, Paragon Shopping Center, and we've already made reservation for a few people. So I'll tell you more in details. All right, on Saturday, this particular restaurant has a 4.5 stars rating out of 780 reviews. So it's a pretty good one. And guys, thank you for all the comments. As long as if I left a thumbs up and a love shape for you, that means that you are actually one of the selected people who will be going for the lunch date with me, okay? So later on, when we do the spin the wheel lunch with Kel thingy on Saturday, you guys will know who are the lucky winners. All right, thank you once again. Please continue to leave your comments from today until Friday. Okay. Disclaimer apply as usual. Do note a lot of good information be shared today. So please make sure you do your risk assessment. And thank you, AIMS, for the kind sponsorship. Now, first of all, let's recap what happened last night. What a recovery. 386 points, 82 points. Don't you realize it's something that it's like today they down 300, tomorrow up by 300, tomorrow down by 400, they go up by 400. It's like basically playing yo-yo, right? This is called algorithm trading. So you can see that Microsoft was down, but they went out to push up this Apple, they push up Meta, right? And then Amazon was down yesterday, but they went to push up other than the bank sector itself. So they are playing around with it. So Microsoft was down by 2.5% down to $272. But again, we all know that this is just temporary reprieve because main thing is still the bank. So basically, it's all right. They are telling you now the bank crisis is over. No more problem, things is good. Now, to me, it's all right. Maybe liquidity-wise itself, the crisis may be over, but the credit crisis has just begun. In fact, it's all right. We all know that it's a forced takeover of Credit Suisse by UBS, engineered by the Swiss government. They were never a happy couple to begin with. I mean, pretty sure UBS didn't want to buy Credit Suisse, but what to do? So your government asks you to get it done, you got to get it done. So what is happening right now? The US regulator have backstopped SVB uninsecured deposit and offering new funding for the troubled banks. Okay, we understand that. But and of course, the KRE gained by 1% after tumbling by 14%. So the market is just focusing on now, okay, we rebounded. But you must understand the market has went up by 14% in a single week. So all I can say is this is not a healthy sign. And I believe that this coming Wednesday, the Federal Reserve will likely increase by 25 basis points for the interest rate. Now, the moment now, the Fed fund rates are all looking at about 73% minimally, right? While some are looking at basically no event, but I don't think so. 25 basis point most likely because ECB has risen up 50 basis point. Federal Reserve cannot be anything lower than 25, okay? Cannot be. So that's why now you can see that the 17 billion wipeout Credit Suisse bondholders has not gone down well in Europe. It means people are not very happy with this. And of course, the Saudi National Bank, who didn't want to help Credit Suisse, is down by $1 billion. Wow, a lot of money. And Amazon now is trying to lay off more people. And that's the reason why I feel that unemployment data will creep up very soon, okay? Now, before we go into that, right, globally, we just saw Xi Jinping meets Putin in Russia. And of course, the way they address each other is like, okay, like good buddies, yeah? But the thing is this, why would Xi Jinping now go and find Putin right now? Because we all know that now, apparently, Putin's a wanted person, okay? All right, so the question is this, okay? Is it because that China is going to tell Putin and do what you need to do, we support you in one way or another because you cannot go down. Yes, indeed, because now what is reflected on by what Putin is doing is something like what China could do with Taiwan. So that is the reason why the people are condemning this little trip here, but to China itself, say, no, I'm a peacemaker. Interesting. Let's hope that everything stays there. If not itself, right, this could be a really big prelude of another bigger thing, yeah? Okay, so we all know that basically, right, the couple, okay, wasn't very happy with their so-called buying, okay? Something that let me just, there's something wrong with my PowerPoint, just give me a minute here. Okay, on, yeah. Okay, I think there's some issue here on PowerPoint. Let me just get it up. Here we go. Okay, so first of all, right, we understand that when they signed this agreement, this takeover, right, basically UBS was not in the right happy mood. So you can see that black face here. Okay, so the thing is this. Oh, I think I know what happened. Gosh, okay, I know what happened. Hold on a minute. Okay, here we go. All right, so we can see that right now UBS is take over a 166-year-old bank. And obviously, it's all right. The Credit Suisse staff are now very worried with the uncertainty with the UBS rescue plan, because most likely UBS will cut away a lot of people. That's for sure, to cut down costs. All right, that's something for sure. And now the Credit Suisse bankers flood the headhunters with calls after rescue. All right, so you can see that right now, a lot of things happening. And more important, look at the chart. Okay, this is UBS chart. It gap up earlier in last night. Then after it basically reversed course and heavy volume was traded, because people are very fearful right now. They fear that UBS, because of this buying, they may actually cause more problem for themselves instead. And of course, Credit Suisse, as you can see, the share price plunged all the way because of the offered price, and it closed at about $94 US, I think, down by 52%. So heavy volume, RSI, ridiculous level. Some people are asking me, is it time to buy? Well, if you don't mind taking a risk and to potentially lose something here as well, you don't mind, just basically can try it. Okay, I mean, you can really consider to just buy some at 94 cents. Okay, and maybe if it goes down further for 50 cents, you can consider just cut your losses. Okay, because if it's correct, it may go back up to 150 in the near term, but that is a long shot, because I think that there's a lot of problem unsettled, and I don't think that in the near term they can settle this. Because people are buying it because they think that could be another Citibank. So you can try, but I just wish you all the best. Yeah. All right. Now the thing is this: the Credit Suisse AT1, not AT1, but AT1 bondholders are very pissed. Definitely. I mean, you're a bondholder, you expect your money to be safe, you get interest paid out. But now you're telling me now the $23 billion bondholders may not get a single cent back. This is really, really incredible. Now, in a typical write-down scenario, the shareholders are the first to take a hit before the AT1 bondholders. But now it flipped the other way around, and now apparently this provoked a furious response from some of the Credit Suisse AT1 bondholders. This just don't make sense, okay? So this guy is very pissed, and I think that if I'm also very pissed, okay? Because you cannot do that to me. I mean, we buy it on the expectation of safety, not because to lose a whole chunk of money. All right, it's ridiculous. And something to take note of, the European financial system credit risk hardly barely budged on the weekend news after the safe. So that means that, right, even though Credit Suisse is saved by this UBS, but you notice that the financial system credit risk didn't budge at all. That means that it's still very high risk here, even though it's off the high, but it's still very high. So that's the reason why you need to be very careful. Now, First Republic Bank, look at the share price. Oh my goodness, it has plunged and all the way to $12. Now, something must take note, guys. It was actually, you know, this guy was actually at 140 just 1 month ago. And then after that, now it's at $12. It's like 90%. My goodness. Now, I know the volume is ridiculous, it's heavy, but you must understand, guys, if you don't buy any of this share right now, you can either have a good chance of going back up again and make a lot of money, double, triple your return. But on the same side, you may lose everything, okay? So if you're okay to lose everything, at the moment now on technical ground, it's really, really a buy. But do understand this bank itself, the IPO back then was here, and look at it, it's now below the IPO price. This is how scary it is. And imagine all these people who've been buying all the way up the side, right? Oh my God, this is how bad it is right now. Imagine all of them are cutting and cutting. So you can imagine how bad this thing can develop, yeah? So you can see right now that for this First Republic Bank, you can see the share price kept going down after the SVB failed, then the 30 billion build out, and basically so even now the UBS are buying into Credit Suisse, it didn't really help, okay? So now all I can say is this: there are more potential smaller banks are going to get more problem, panic is spreading, and likelihood is all right, they need more help because the 30 billion is not enough. So all I can say is now JP Morgan is trying their best to assist, all right, and help the bank. But we all know that this our help itself is going to be just touched on the surface. If this is really too bad, it's very likely JP will say, oh, you know what, I can't help it much, and then we just let go and things will get very, very ugly. So some experts now say that let's do a timeout, guys. the Federal Reserve must really time out now because it's not the good time to be getting into the market. They feel that it's really too much. They think that we should take a little break. So let's see what this expert has to say. Let's go and take a look. Oops, sorry, wrong one. Where is it? Over here. Okay, let's take a look over for this video.
2 days away. Our next guest wants the Fed to take a step back and end the rate hikes. Peter Bookbar is the Chief Investment Officer of Weekly Financial Group. He's also a CNBC contributor. Peter, great to have you with us. And it's interesting how quickly people went from one side of the boat, 50, to the other side of the boat, which is either pause or 25. There is a case, though, to be made in theory, that regulators have done so much to backstop the financial system, whether it be here in the United States or globally now, given the events over the weekend, that enables the Fed to keep, pounding at inflation and go ahead with the rate hikes.
I think that's what they're going to do. And it'll be 25. And while Powell's not going to use the word pause, he's going to basically imply a pause and that they'll take a step back and they'll see how things play out. I think from a risk management standpoint, they should be doing nothing. I mean, the world has changed. The world has changed a lot just over the past couple of weeks. And the Fed needs to really start thinking about how things unfold from here. So before the bank turmoil over the last couple of weeks, we've seen the tightest lending standards, not including COVID, in commercial industrial loans since 2009. The commercial industrial loan level in terms of amount outstanding up until the day before it totally unraveled with SVB, it was no higher than December.
Right. So basically, right, we all know that now the market really need a timeout. But I can tell you this, guys, they will not time out. Okay. My view is that they'll continue to raise interest rate 25, a slower pace, but definitely they'll keep on doing that. Why? Because they cannot allow inflation to creep up. I'll tell you why they cannot very shortly. So that's why now Mike Wilson from Morgan Stanley is saying that, right, this is actually the beginning of the end for the bear market. Oh, okay. So meaning that we are near to the end of the bear market, but this is actually the beginning of it only. That means they're going to see the bear coming in right now. So that is what Mike Wilson has said. So while traders are taking the regulatory backstop deposit as a positive sign, Morgan Stanley, Mike Wilson say, nope. With the backstopping of bank deposit by the by the Fed and FDIC, many equity investors are asking if there's going to be any form or another form of QE, and therefore risk on. So this is for Morgan Stanley. They don't think so. They argue it's not. Instead, itself, right, this will be actually a problem because of falling credit availability. The falling credit availability squeezes growth of economy. That means that when you basically when you do this, right, the credit availability will be reduced. Okay, and then when that happens, right, you couldn't have the economy going up. All right. So this is going to be interesting. I'll tell you more in detail. But the thing is this is something that we all know, that with all these things right now happening in the bank sector, definitely for sure, the lending standard will get even tighter. That's confirmed. This one, obviously, we know that, yeah? So if that happens, right, the cost of deposit will continue to go up. And that will definitely weigh on the net interest margins for the banks. And because of that itself, right, the bank won't dare to lend out money, they will earn lesser. And then what happened? The earnings will drop. So again, this is going to be a problem. So that's why in short, right, the risk of credit crunch has increased materially in our view, according to Mike Wilson, and I totally agree. And that's why it's a credit crunch right now. So he has mentioned that, right, okay, the performance breadth measure is troubling. In fact, example, right, the cumulative advance and decline indicator for the Nasdaq Composite has dropped significantly over the past several weeks, meaning fewer stocks are participating in the benchmark rally. And that's why I just said earlier that they're rotating the funds, moving around. They're just putting who to go up, who to go down. But you can see that it's not everyone is moving up. That is a market internal problem, and it's not healthy, according to Mike Wilson. So Bloomberg interviewed him. Let's see what Bloomberg has to ask him. Let's go, Bloomberg.
It gives you more confidence here that the bear market is over, a new bull market is afoot. Is it specifically about economic conditions and economic conditions alone?
Well, no, actually price will usually lead. Okay. So what we're looking for is price, meaning that the price has never really, factored in the growth concerns, right? The bear market to date has still been, for the most part, about the Fed, inflation, and interest rates going up in, very quick manner. and that has compressed valuations. But at no point in the last year have we seen the equity risk premium component, similar to credit spreads, by the way. Those usually blow out when they're really concerned, when stocks or credit instruments are concerned about growth. And that hasn't happened yet. So we really can't say the coast is clear given our view on growth. Now, if we were more optimistic on growth, then we would probably be saying the bear market was over in October when we called that rally back at that time, because we thought there would be a relief on the rate side, which we got. But now, given our view on earnings and of course this potential credit crunch, we think the risk has gone up for that equity risk premium to finally come home and hit the price earnings multiple. So that's the thing we're really looking for, Romain. And then, obviously the economic data and the rate of change on growth will follow. And we just think people are being impatient here because look, bear markets are exhausting. Okay. I'm more exhausted than anybody because I've probably been bearish the longest, and we all want it to be over. But it's our job to point out to clients that the risk reward is still not attractive given our outlook.
Right. So it's pretty clear that to me, it's pretty correct. And the thing is this right now, that it's not that the bear market is not over. It's just that we still need that little push down. We need to basically get away inflation. We need to basically weed out all those bad companies or those who mismanage the companies. Then, and the environments have to come down very conducive for investment because the risk is still high, even though, and the value is still pretty high for most stocks itself. So all these actually must be done before we can see a market bottom. And I'll tell you more with some similarities in the charts. You actually see more in detail, because now take a look, guys. This is the Baltic Dry Index. Okay, this is the Freightos Baltic Index. Sorry, my bad. So this is actually a representation of Global Container Freight Index, and you can see right now, guys, what a crazy momentum now. It is actually from here itself at a peak that was just January in 2022 last year, and now it has came down all the way to where it started. Now, of course, you may say that, okay, like that means it's good, right? That means the cost has reduced. No, but the same thing is, so that means that the demand, the global growth is not there. This is the scary part. And that is why we must understand the problem here itself. Because if you remember what happened in 2007, okay, we have the first leg of the liquidity crisis in August 2007. Then the second leg came in, was a collapse of bear stern in March, April 2008. Very interesting, right? Yeah, don't you find that interesting? Because now we actually have the crisis back in this 2022. And then now we have a bear stern, which is something like the Credit Suisse. And it's happened in March and April, which is exactly right now. And the final leg actually happened was a collapse of Lehman Brothers in September 2008, which is something I really suspect may happen. Not Lehman, but another company. And this company could be bigger than Bear Stearns. Okay, all right. So you can see that Lehman was bigger than Bear Stearns, and it happened. So to me now, right, I believe there's another company is going to happen, and this company is bigger than Credit Suisse. And I think that you should know who am I referring to. Watch my last few videos, you probably got the idea. So now, if let's say now we have a repertoire of the financial crisis, okay? So is SVB or Bear Stearns or Credit Suisse the next Lehman? If they are not Lehman, then is there going to be a bigger crisis in the horizon? And that is the scary part of this thing right now. And I think that it may actually happen. So now you understand why is our today's video so important? That's only the tip of the iceberg, more to go. So let's take a look here. We all know that the Federal Reserve will always break something, but that is their job. Their job is to break something, right? Isn't it true? So let's take a look here, guys. Okay. So first of all, you can see that, right? When the Fed fund rates goes up, okay, goes up, right? We do have the credit cards going up, okay? Consumer loans will go up. That's natural. And of course, the other consumer loans will go up, right? Yes, indeed. So you notice that almost every time itself, right, when the Federal Reserve do all this interesting thing, after that itself, right, you will hit a recession. This is a recession area, okay? And you can see that the market really, really comes off. So now where are we? We are not even near there yet. Everything is at a higher end right now. So we haven't reached the point of recession yet because we're still moving up. So until we see something like this, then we can have that recession. And I believe that, again, we can put into writing here. I strongly believe that we'll see a recession, okay, which I've been saying this for the longest of time, right, in August, okay? I'm really very confident in August 2023, we will see the official official recession, okay? And that is whereby before that itself, by June, I believe that the stock market will really come off, all right? So that's why we're preparing for this right now. So guys, think about this. What do you think so? Let's continue on this. All right, so let's watch this again and again and again and again. So from 1980 to 1990, right? You can see that's what happened back then. You can see pretty cool, very cool stuff, right? So 1980, we can see this, whereby the 10-year yield and the 2-year yield, the spread got so big that it hit -2, and that was where immediately we saw the recession coming in. Now in 1990, we have same thing as spread open up, I mean the inversion, and then after that we have our very own recession once again, which is here. Okay, can you see that? Pretty cool, right? And in year 2000, we have same thing again, and then we have the recession. In 2008, we saw that again, and we have recession. Pretty cool, right? So that's why I told you, right, 1990, 2000, 2008, they are the same. So now today, where we are right now, we just hit minus, we are hit -1. And you notice right now, do you notice this? The inversion has starting to turn. Now, this is a very critical thing here to watch out, guys. The inversion is turning. All right, it's turning. Can you see that? It's turning because of the sudden drop of the yield. The 2-year yield have been coming down very fast, right? Because now there's speculation say that there may not be any more interest rate hiking. Hence, therefore, the 2-year yield drops so fast, so causing the inversion to recover. But when that happened itself, that means that the credit crunch is coming in, right? And that's why recession is coming in. Definitely, for sure. It's definitely coming in. And that's why you need to be very clear to what to prepare, guys. So now we look at the similarities now. This is actually the price action, whereby Game of Trades, one of the YouTuber is doing. I like this chart alone. It shows that, right, the last time we saw, right, it was very similar. The last 14 months in the year 2000, it was very similar. So later on, right, if everything goes according to this chart, that means that we may see a bit of retracement, yes, a bit. Then after that, right, we will see some huge selling that is really beyond. And that is what Mike Wilson and Marco Kolonovic, all of them are saying. Of course, the other people don't really feel that way, but that is something that you must consider. Okay, so now we can see back in 1990s, whereby unemployment will usually go up. Now you can see that unemployment now is very much. So we suspect that by May onwards, right, unemployment will go up. And this is something that happened back in 1990. And it's almost similar to 2008 and 2000 itself. And of course, at the same time back then, you will see that the Federal Reserve is going to reduce to ease the monetary policy by cutting rates. And when that all happened itself, recession happening, that's why you see the stock price coming down. So again and again and again, you will likely see this happening because why? In 1990, year 2000, 2008 is similar. So of course, today, 2023, we are likely to see unemployment going up very soon. We're going to see Federal Reserve going to cut rate very soon. And of course, the stock market will likely come off because that means there'll be a problem. So all these things is going to repeat once again, and nothing new here, guys. So I cannot see why the other people are not seeing right now, or they know it, but they just keep quiet. Because now you can see, right, even though the yield is really going crazy, but you can see that, right, a lot of swings, a lot of buying are coming in, and the intraday of a 80 basis point is really crazy. That means that there's a lot of uncertainty now in the market, and that's why you need to be careful. Now, this is a very interesting chart. I got it for you. The gold has such a key level relative to oil today. That means that, right, when you come to this calculation of gold versus oil, and if 1 ounce of gold can buy 30 barrels of oil, right, it's like a very interesting calculation. And you notice, right, every time when this happened, okay, when this happened, right, you will notice that that is where we have a crisis. So back then, it's all right. Remember that is back in 1990, there's a crisis over here, and it happened again in 2016, a bit of selling effect, remember? So now it's happening again. So if this is going to be a good indication, right? So again, it's stressed up that we're going to see a recession coming in. Okay, it's going to come in, and it's going to come in hard and fast. So people are working for other people, right? You must be very careful, do upgrade yourself, prepare yourself, save for rainy day, because this is not going to be good. Yeah. So now we all know the US dollar being dumped to the low end. I can tell you this, guys, is that now people are very fearful of the US dollar because they know this. They know that the only way to save the day is to cut interest rate. And when they cut it out, the dollar will go fall down, go fall further, right? Because now everybody's increasing interest rate, but yet people are very worried of US now. That's why the dollar is selling. And of course, if the dollar is selling, you have high risk like Bitcoin is going up, which is not a good sign. It actually, to me, itself, right, this actually creates a problem in the looming time. And of course, the one that we have been buying is gold, because gold will benefit from a lower dollar. Okay, so all these are very interesting stuff. But more important thing is that now, very clear, Goldman Sachs says that the market implied recession risk for the next 12 months has picked up by 50%. Okay, and because of the Federal Reserve. But historically, this drove more equity drawdown risk, especially if the risky assets were reflecting little recession risk. So apparently now the so-called the risky assets are not showing it. They only show about 13% probability of a recession. So you actually have a lot of people don't believe that there'll be a recession because they don't see it. But if repeated pattern is a way of life to know what will happen next, then of course this is scary. So now we know that the bank is going to tighten up. Okay, we all know that. So liquidity crisis is over, but then we will have credit crisis. Okay, so liquidity crisis is expected to be passed soon, but the looming one will be the credit crisis. This credit crisis will likely affect small businesses accessing to credit than the large corporation. Yes, the bank will still continue to support the larger corporation because they know they survive, but they know the bank will know the bank will know that they may not, those small companies, businesses may not survive, right? So they'll be very, very strong on them, and that is a problem because if the small business fail, then what happens next? Unemployment will shoot. So that's the reason why regional banks that have been filling the small business, right, may be limited in their ability and willingness to lend. That's why SVB, all these companies are going down because they did lend, and of course they can get better money. That also added on to their problem. And this trend has already been, is happening. And of course, this trend will continue now. With so many smaller banks are closing down, that means that whatever loan they give to people, they're going to get it back, are going to force return or recovery. And then if that all happens and stuff, right, you cannot imagine what will be next. So that is the reason why you can see right now things are really not going according to plan, and things will get scarier as it goes by. Yeah, just give me a minute. There's some technical issue here. Let me just give me give me a moment. Okay. All right. Sometimes in life, this is something I prepared myself, but then I just have these technical issues just popping up here as and when. Okay, let's go. Let me have this, get it up. Now, the thing is that the Fed fund rate now basically have increased to 73% for 25 basis points. So no longer people talking about the 50 basis point. Okay, fine. But if you look at the numbers, you can see very clearly now, they really can't do that because the CPI figures is going up. The CPI figures is going up, whether it's CPI core service, because less housing itself, all these numbers are actually moving up. And now the CPI urban consumer core is going up this way. It's not coming down. So all this information basically will make Federal Reserve think twice of really reducing to nothing done. Definitely, they will really have to weigh this, and it's going to be a 25 basis point. And if this number can go higher, we watch out for this. You continue. So to me itself, will be 25 plus 25 plus 25, and that will hit the 5.5 mark, and that's where things will break. So now the S&P 500 now is watched very closely because now he has just broken back again above the MA 200 and MA 150 at the same time last night. And the volume has been still pretty strong. So all I can say is this: if the market wants to pump out, right, the market can actually come back up to somewhere around here, and that's about 4,000 or 3,980 around there. But then again, if it fails, it should be coming down back to the 3850 zone. All right, so that is my take on the S&P 500. But just take note itself, it's now back above the 100 and 200 MA. So some people are saying that this is very bullish. Yeah. Now, one thing to take note of is that last night after market close, right, the option market is not very nice. Seemingly, some people are pretty bearish. So all I can say is be careful. All right, guys, with all this information out, you probably know what I'm going to go for. But remember this, the technical will still override, the trend pattern will still do that. So we need to combine everything to have the best trading direction. All right, see you guys. This is Cal signing off. See you in the technical side. Bye-bye.